Hi, this is Kerry Artak with both Wicked Stocks and Artak Advisory, bringing you monthly analysis in the U.S. dollar index. I've been doing a monthly U.S. dollar index video analysis now for the better part of a year, and I'm just going to update you on the chart as we move into the month of July, and I'll be doing this on a monthly basis for the foreseeable future. Because, I know many of you, especially on the commodity side, are very interested in what the U.S. dollar is doing. The RTEC advisory, that portion actually addresses the concerns of large-scale commodity producers. And so obviously as export products and such, with respect to the grains and livestock, that's a very important element, the U.S. dollar. Also with the stock market, Wicked Stocks, there's a relationship with the U.S. dollar and the U.S. stock market, especially as it concerns companies that are import or export sensitive, and many are. So now I'll let you sort of derive the how you interpret what I'm about to tell you with respect to the U.S. dollar index. I'll let you decide. Many people have their already existing opinions because there's a number of variables, obviously, with the U.S. dollar index and the stock market in particular that come into play. You've got interest rates and so forth and so on. I don't want to go there. This is a technical analysis of the U.S. dollar index. So what you're looking at right now is a monthly bar chart of the U.S. dollar index. This is the index itself. This is not the futures instrument that's traded on the ICE Futures Exchange. This is the index itself. It's been in existence now since what was the Bretton Woods and the dismantling of our of the gold standard. I believe that was, I don't know the year, but you can see on this chart, it was in the early 70s, late 60s, early 70s, maybe 1969, 1970, 71, something like that. You can see the extremes. This is a monthly chart once again. This chart goes back over 50 years. February 85 was the extreme high. March of '08 was the extreme low. And if you follow the chart here, and I don't want to go back too far, but coming off that '08 low, obviously the market, the U.S. dollar has been strong since, culminating with that, I think that was the September 22 extreme high. And I just want to show that at that time, there was a beautiful convergence between a rising channel top that is 15 years in the making, that is presently this month, the month of July, at 114.76, and a long-term descending two-thirds speed line that this month, the month of July 23, is at 112.45. There's still relative convergence, but they all came together in the mid-113 handle in September, so it couldn't have been a more picture-perfect convergence of two significant long-term resistance areas that did obviously contain the buying pressures for the U.S. dollar. We've been falling off pretty much since then. We've been in a consolidative framework over the last 6-8 months. I'm going to open this chart up so that we can see closer some of these levels. But one of the points I wanted to make, if you're not familiar with the speed line, you can see back in 2014, I think it was, we pushed through the descending one-third speed line. The target with speed line analysis is if you push above a descending one-third speed line, your overall objective is the descending two-third speed line, which we presently see at 112.45. So that took years to play out. They did culminate with the September 22 high. In terms of how to construct, very simple. Basically looking at the two-thirds upside retracement from the February 85 high against that March '08 low. So two-thirds of the way back up is actually 133.32. And so you draw a trend line projected off that February 85 high. It drops and intersects at the 66.6%, the two-thirds percentage upside point at 133.32 in the time frame in which that March '08 low was made. It's as simple as that. And so it is a sort of a trend line in the middle of nowhere in this particular example as it drops. It's similar to a Gann line, if you guys are familiar with that, but it is not a Gann line. It is a two-thirds speed line. I've been using it for years, especially in the commodities. They work well in the stock market as well, especially particular stocks work better than others. In any event, the convergence between that speed line presently at 112.45 and the rising channel top at 114.76 held the highs in September. We've been falling since, consolidating over the last 6 or 8 months. Now, it's worth noting, and I'm going to zoom in here in just a moment, but on the way down off of that convergence in the 112.45 to 114.76 area, A rising one-third speed line, 33.3%. I show you how to construct that here as well. Has been holding the market well for the last 4 or 5 months. And you can see that it's that downside one-third retracement from the March '08 low against that September 22 high was 100.09. And once again, you're drawing a trend line off that March '08 low, and it actually intersects in the time frame in which the September 22 high was made at the one-third downside retracement level, 33.3%. And so it is moving upward over time. It is at 101.79 the month of July 23. So let's open the chart up, and I'll show you. This is an opened up chart, the same exact chart. You can see that 101.79, that is the rising one-third speed line. It's been holding the lows now for the last 1, 2, 3, 4, 5 months or so. We've actually tested it on the monthly chart 3 times. We've broken below it a bit, especially several months ago, but did not close below it at the end of any month. And so it is our base of long-term support. 101.79 rising speed line. I'll apprise you of its value as we move into August, able to contain selling through the rest of the year, possibly well into next, and above which you can make the case for a revisit of that 112.45 to 114.76 region, that long-term resistance area. Now, on the way up, I will show you that we do need to close above 105.82. That would be a buy signal as we move into the fourth quarter of this year. So if we happen to settle the month of July, the end of July, above 105.82 in the index, it would set off a buy signal that should play out. Now, the timing is next to impossible. It could be a rapid rise within 3 to 5 months, or it could take the better part of a year, depending on volatility, of course. But closing above that 105.82 would end the congestive pattern that's played out now for the last 6 or 8 months. And with that, I would expect steady gains into the 112.45 to 114.76 region, where once again the U.S. dollar can top out on an annual, possibly decade-long basis. Now, downside, if we happen to close below 101.79, then I see that 93.54 rising channel bottom. Once again, keep in mind, that is a 15-year channel bottom, and the timing of that is next to impossible, of course. It could be a rapid descent. It could be within, I don't know, I'm guessing here 5 to 8 months, or it could take more than a year. But if we close the month of July below 101.79, and I think you should throw in a 1% marker on that. In other words, you're going to subtract a 1.02 from 101.79. That would be 100.77. If I did the math proper in my head, settlement at the end of July of 100.77 or lower would be a valid sell signal for the U.S. dollar index. And I would expect then the U.S. dollar index to continue dropping into that 93, 94 handle, within a full year, quite possibly sooner, possibly within 5 to 8 months, depending on volatility, of course. Just an FYI that 93.54 channel bottom rises to 94.32 by the end of the year. So it's a very slow rise, and it would become our long-term objective if we settle below 101.79. But once again, I would characterize the U.S. dollar right now through the rest of the year as a two-sided framework, still congestive between 101.79 floor of support and 105.82 ceiling of resistance. We could trade inside that area for the rest of the year. If we close above 105.82, then we're looking for the 110s, 112.45, 114.76. There are other things up in that vicinity that may well contain buying pressures, not only through the rest of the year, but through next year and possibly into later decade. I will mention, if you're watching the stock market, here's an S&P 500 chart, a monthly chart going back the same 15-year time horizon. And if you've been watching my S&P 500 weekly analysis in Wicked Stocks, or my SPY analysis, my daily SPY, that is the S&P 500 ETF, my daily video analysis in Wicked Stocks, you know that we've had a series of buy signals in the S&P 500 index. In fact, I'm calling it a resumption of a long-term bull market. And we just can't say the same of the U.S. dollar. So, there's a divergence right now. The two have been in relative lockstep for, the better part of a year until very recently, until the last 2 or 3 months, where the S&P 500, the U.S. stock market, as represented by the S&P 500, has pulled away to the upside. And the question begs, of course, what will the U.S. dollar index do? If the correlation remains, it will settle above eventually that 105 105.82 horizontal channel top. But if not, obviously it could eventually close below 101.79, in which case we're looking for, I would just call it the low to mid 90s, that 93.54 channel bottom. And I'm not going to make any strong comparisons anymore with the stock market and the index. I don't think, here's my personal opinion, that I don't think that if we close below 101.79 on that speed line in the U.S. dollar index, and then anticipating that 93.54 channel bottom in the months ahead, that it would kibosh the buy signal that has recently played out in the S&P 500. I think there could be a divergence that could play out for a long time to come between these two. But nonetheless, you can't help compare the two. They've both been in a relative bull market since that '08 low. So I'll leave it to you. I'm going to leave it at that. This is really more of just a courtesy or just providing you kind of a backdrop of the U.S. dollar as we move through time. And I'm going to leave it at that for this particular Artec Advisory and Wicked Stocks analysis on the U.S. dollar index.